All right, so let's get into the nuts and bolts of the fund. It is called Real Income Properties Texas 1 LLC because we plan to do more. And here's the business plan. To acquire 1 to 4 unit properties, renovate with high-end finishes, and lease to highly paid professionals in rapidly growing markets throughout North Texas. The target return is 8%, timeframe 3 to 7 year hold. So Leah, do you think it'll be mostly single family homes or, duplexes, fourplexes? What are you seeing?
I think it's going to be mostly single family. I'll tell you what I've been seeing with my own acquisitions is mostly single family, maybe 10% duplex. And really that's the majority of what we get access to. But certainly we're all about buying what makes money. And so if we get a good triplex or fourplex, or, sometimes what we'll do is buy groups of duplexes. So it might be a complex of 4 duplexes. So technically an 8 unit. So anything that fits that bill would work perfectly.
Wonderful. And why high-end finishes?
Well, so it's really important, not only from the tenant perspective, but also the resale perspective. The finishes that we like in these properties are your granite countertops, shaker cabinets that have a nice baked finish, vinyl wood flooring throughout, no carpet. So they're luxurious for the tenant. Class A finish out means we're going to attract a higher quality tenant, but it also means that we're not going to be having to redo these things for resale. And so whatever we do up front is going to hold us through this period and then be what's considered beautiful and luxurious for the resale on the back end as well.
And target return, we were conservative in our underwriting. Part of the appreciation is forced appreciation, which I'll go through in the next slide. Time frame 3 to 7 year hold. What would determine 3 years or 7 years?
So I think it really is going to depend on what our market does in appreciation. So for example, when we talk about being conservative, the total amount of appreciation that we're projecting after the initial acquisition is the total that we saw last year. So I think those numbers have a lot of flexibility. If we continue to see years at 20 or 30%, then that's going to mean that we're probably going to exit sooner than if we see appreciation at 9 to 15%. So I think it's all dependent on that, but also how much the rents continue to go up. Right now, we're seeing very high rent increases, and so that keeps the returns great. So we're going to be looking at the market every year, looking at what it's doing. And of course, when we go and leverage, we can go back in and buy more. And some properties in one city may sell a little bit sooner than properties in another. So we'll just be monitoring that and keeping you guys up to date.
Wonderful. Okay, so the business plan again is number 1, forced appreciation, which I mentioned. We'll be creating built-in equity year 1. And that's what's really exciting about this fund is we get to share in the way that Leah invests. So explain that. What do you do? What are we doing?
Absolutely. So what we do is we buy properties way below market value. We fix them up. And so what the all-in is, what we call the all-in, which is your purchase plus renovation, is a lot less than what the value of that property is. And the great thing is when we go and leverage out of them, if the market has great terms for that, then they're looking at what the value is all in of what it's worth today, not just what we spent. And so that allows us to take that capital even further to have more properties, hopefully appreciating at great returns.
So forced appreciation, then cash flow, of course, investors will receive cash flow distributions from rental income quarterly once stabilized, of course. And 3, profits. So we do expect prices to continue to rise, no guarantees. We cannot know what the future brings, but based on all the business growth we're seeing in the area, we expect that there will most likely be appreciation in the future. Certainly over 3 to 7 years, especially when all those companies build their warehouses and their, the buildings that they're starting.
Until somebody figures out the magic fix for the housing shortage, I don't know what they're going to do to fill all those people.
Yeah, that's right. Okay, the manager will consider the following property types.
So we'll be looking at potentially new homes, and this will not be your standard new construction acquisitions. Sometimes what happens is an investor or someone starts to build a home and they either can't finish a few final items that need repairs, or they wind up needing to liquidate it very quickly. And generally that's because of whatever financing terms they're in, if they're in hard money or something like that. So we're not going to be building homes from the ground up. We'll be buying completed homes that might need minor repairs, but most of the properties are going to be homes that either need renovation or that have previously been renovated, either to our standards or needing additional renovation. Again, predominantly that's going to be single family homes or small multifamily packages.
Okay. Of course, the investment highlights are it's diversified, lots of properties. Instead of you just owning 1, 2, or 10, you get to have a piece of a lot of properties and spread out. Current cash flow and long-term appreciation, as we mentioned, and forced appreciation. High growth markets, very high. We talked about that in the other webinar. What's going on in North Dallas is incredible, and North Texas. It just continues to grow. Streamlined vertical integration of company operations. Talk about that. This really saves a lot of money. I think it's where the bigger institutional funds are missing. They're missing you, thankfully.
Well, thank you for that. Yeah, so my primary company, our property management and acquisitions company that I'm sure many of you have heard me speak about before, we have everything under one roof. So we already have the contacts, we already have the maintenance crews, we already have the leasing team, we have all of that built in. So instead of having to go buy all that staffing, we're just having a property management fee to allow that to happen. And so we get to piggyback on those benefits. And I think really what that's going to allow us to do is jump right in, go acquire those properties and have the great success like what we do for our own personal portfolio. So I think at the end of the day, it's about having a model that works to keep these tenant occupied and keep them in good condition while we wait for that exit strategy. And of course, that's where we've built our property management model off of.
And, there's such a dearth of inventory on the market. How are you getting access to significant deal flow in such a competitive market?
At the end of the day, it's about relationships. A lot of these people that we buy from, they come to us. They don't even go to anybody else. I'm a very high volume buyer, if not the highest volume out there. I'm one of them. And so what happens is when they get a deal, especially those that need work, they're going to come to me first because they know when I contract on a property, I'm going to close. And that's huge. But it's also about the ease. So when we're doing these properties, we're not making them contingent on financing and inspections and all those things that perhaps maybe other buyers would have to do, because we can go in, assess it right then and there, make a deal and sign a contract and get it ready to close. So there's a lot of differences when you're working with an investor like me. But I think at the end of the day, it's 17 years of working with these people day in and day out and building those relationships to where over 75% of what I buy and what's going to be going into this fund is likely going to be completely off market.
Fantastic. All right. Why rental housing? We've already gone through this many times, but let's just run through it. Why do you buy rental housing? And I know last time I saw you, I was talking about retail and warehouses, and you were like, why? There's a need for housing. So
yeah, I know a lot of people who are heavily invested in commercial real estate, and I have some commercial that came as part of a residential package. And the first thing I do is try to sell it. At the end of the day, no matter what the market does, people have to have a place to live. We were in a massive housing shortage going into COVID. That housing shortage has been building, by the way, for decades because we just physically aren't building enough houses. That's not a new problem. The average age of home is aging and it just doesn't allow enough inventory. And so we'll look at the numbers here in North Texas. Going into COVID, 40% of people on the Fort Worth side and 50% of people on the Dallas side were renters. There's just not enough inventory to fill that. And as long as there's that supply and demand issue, it's going to continue to remain a great investment. But you look at now what interest rates are doing, inventory shortages for buyers, people are becoming renters. And on top of that, our market is massive. If you've ever been to Dallas, it's a huge amount of geographical location. And so people that come here don't really know where they want to be yet. And so they'll rent for a year or two. These are high quality people that then turn around and buy. And actually, a lot of them wind up buying the rental that they live in, funny enough. And so it's about having that need and being able to fill it, but knowing that no matter what the market's doing, people have to have a place to live. As we saw with COVID, you don't have to have an office. I think a lot of us probably aren't working in offices anymore, but there certainly has to be a place to lay your head at night. I think the other piece of it is that you really can diversify with rental property. So if you go into a big commercial project or a big project, all your eggs are in that one basket. Whereas if we're doing houses spread all across the Metroplex, it gives you some security in the fact that not everything's in one place and in one property. And that's one of the things I love about a fund is because you can diversify that risk.
yes. And obviously appreciation, cash flow, stability and control. versus other asset classes. There, like you said, there'll always be people who need a place to live, but maybe businesses will work from home or something. They won't need the office.
Well, and right now is the first time that rents have been cheaper than a mortgage. And the interesting thing about North Texas is we're the only large market that still has an affordable percentage of what the gross income is relative to rent. We're still less than 20% for most tenants. So if they're only spending 20% of their income on rent, it can allow them a lot of extra expenses to go have fun, which is why you see so much shopping and all that other development here. And so, the rental play really piggybacks on that too.
Wonderful. All right. And here's some examples. Again, it's going to be a blind fund. So these are just properties that you have renovated in the past, but it gives the idea of what you'll be doing.
Yeah, so this shows you kind of what they look like before. And at the end, all of ours look about the same. We're using similar paint colors. It's whatever color I saw in a magazine I liked that week, but similar finishes, right? So solid surface countertops, vinyl wood flooring throughout the entire property, making sure that we've got tiled kitchens, bathrooms. You'll see here 6-panel upgraded doors, nice upgraded molding. So it's about making them look new and fixing up the areas that we have to, but also not spending where we don't need to spend.
Great. Beautiful. Oh, such a lovely difference.
It's really, a lot of our customers, they come here from other cities where you don't get finishes like this for under 250,000. It's pretty unheard of. So the fact that we can do that in these and keep the cost low is really great.
Yeah. Yeah. It's an upgrade. Certainly someone coming from a little one room, chamber in New York and get to live like that. Okay, acquisition review process. The typical investment will have the following characteristics.
Yeah, so we want to make sure we're getting a great cash on cash return. And of course, that is what is the monthly. And then on top of that is our appreciation potential and that initial equity in the buy. We're looking for 2+ bedrooms. So we don't really deal in 1-bedroom homes, but lots of 2-bedroom homes in these areas that we go and renovate. Some of my best returns are in those small 2 and 3 bedrooms. Generally, they're over 750 square feet. And average rent starts right now at about $1,200 to $1,250, but it's going up very quickly. So, a year ago, I had 2 bedrooms that were going at $1,050 in some of my small renovations, and a lot of those are up almost to $1,300 now. So it's been great just watching these prices climb. And with the apartments coming in so much more expensive, my hope is that trend is going to continue too.
Yeah, these are amazing numbers because when I started buying in Dallas in 2004, 2005, this was the price point. On the 150 to 175 range, 15 years ago, and that obviously this is further out from where I was buying in Dallas, but to still be able to get these kind of numbers is amazing.
The great thing though, is that you were doing the same model. You were buying right outside the path of progress where the highways were developing. We're just a couple cities further now.
And when I bought, I thought I was in the boonies, and now it's like the main metro. So
it is. Funny enough, a lot of your properties are where the executives live now.
Right, exactly. All right, debt financing. So in the first year of operations, we intend to purchase all investments assets on a cash basis. So we don't know where interest rates will be when it's time to finance, but my gut says it will be where they are now or lower because we already maybe saw peak inflation. Today was some good news on that. Who knows? It's only speculation, but you've spoken to banks who are interested in working with you and funding this fund.
Yeah, actually the same banks that finance my acquisitions and what I do are willing to do this as well. And what we like to do is we package them in small groups and refinance as a small group is ready to go so that we can continue to leverage as quickly as possible into more property to, of course, increase those returns. So we've got multiple banks that are ready to go. I'll be guaranteeing that to get us the best terms possible. For those of you who don't know, if there's not a guarantee, the terms are not near as good. So we're prepared and going to do that. And we look forward to being able to get good terms on those refinances.
That's a huge give. So we appreciate that.
And just remember that financing is based on that end value, not what we paid for it. So that's the benefit of doing it this way instead of your traditional conventional financing.
Right. Yes. All right. Minimum investment is $50,000, which gets you 50 units within the LLC. And the total offering maximum that we would raise would be 20 million. The minimum raise to get started will be 2 million. I'm not worried at all about hitting that. I think we're there already in pre-commitments. Deadline 120 days from published date with a 60-day extension, and offering close date 9 months with 3-month extension. And again, this is for accredited investors only. Distributions, the first cash coming out will go towards returning capital. So the amount equal to 100% of capital returned to the investors is how the first distributions will go out. After that, it will be a 75-25 split, with 75% of company profits to investor members pro rata and 25% of remaining company profits to the manager. Let's see, all distributions are made at the manager's sole discretion after expenses, fees, and allowing for any reasonable reserves. And investor distributions are paid pro rata. The manager expects to provide quarterly distributions starting 2 calendar quarters after funds are deployed by purchasing real estate assets. You can tell this was written by an attorney. In order to give preference to early investors, each investor member will start sharing in profits after it's been a member for 2 calendar quarters. Fees, you want to go over this one?
Absolutely. So managers will be reimbursed for all expenses. We have an annual asset management fee of 1.5%, and that's of the total asset value under management. And that's calculated and paid on a quarterly basis. We're going to be giving you updates on how the properties are doing and also how the market is doing. And that will help you have an idea of where the value is at that point in time and what we're seeing in the properties and the market. Acquisition fee is 4% of the total purchase price of each asset invested in, and that includes the repair and renovation cost. So instead of paying us to go in and renovate these properties and oversee that and the staffing and all of that, it's just going to be a flat 4% acquisition fee on the whole amount, which is a lot cheaper. And it really gives us access to all that equity that's going to be tapped into for the fund. The disposition fee will be 1.5% on the sale of each asset. So that'll be at the time that we liquidate the asset. And then if financing is obtained, there's a refinance fee for overseeing that of 1% of the principal amount of the loan, and then a guarantee fee of up to 2% of the principal loan amount for providing the guarantee. The marketing website platform fee is an upfront $25,000 and $250 per subscriber. And then the manager is also going to receive 25% of the profits of the company, of course, with the members receiving the 75%.
Estimated timeline. The timeline, of course, is an estimate. We've learned in 2020 that, you can't predict everything. But the manager has the sole discretion to determine when and if a disposition or refinancing of a property will occur. So how did you come up with this timeline?
So again, this is the same model that I've been doing for years and years. And I already have properties ready to go as soon as we meet the 2 million. So we will be buying just as quickly as possible. My plan is to do a mix of renovation or just quick make ready, easy properties so that we can get some cash flowing as quickly as possible. So I think it's really going to be dependent on how quickly we raise, and then we'll start buying at that point and continue buying as the raise continues. So stabilization, it's going to be property by property. As soon as we have enough stabilized to go refinance those properties to maximize, we're going to go ahead and do that. Usually what I see is groups of 5 to 10, so keep that in mind. And then once we're completely done with all acquisitions and all of the rehabs, that should be within 12 to 18 months. And then the hold is going to be market dependent. So I think more than likely, we're probably looking at about 5 years, but if we see different things in the market, or if we continue on the trend we're on right now, the exit might be a little bit sooner. So it all just depends, but we're going to keep you posted, not only with our quarterly updates, but also, of course, my webinars going over what our market is doing and what we're seeing.
With every investment, there is risk, even though this is definitely a more conservative investment, much easier than the construction that we've been doing. It's been obviously a very difficult time to be in construction. So I love that we're doing a cash flow fund with already built homes. It's wonderful. But nonetheless, there are risks. This is a blind fund. No assets have been identified or purchased yet, but the buy box is really clear of what Leah's going after. Unknown if sufficient properties that fit the parameters will be available at anticipated prices. So, things could change and prices could go up. That's why Leah's like, we got to get going. Everybody knows now what's happening in Sherman. Limited geographic diversity, as all properties will be in North Texas. So, I don't know, massive meteorite, meteor hits the area, that would be a problem. It's illiquid, which means that the money's been spent, so you can't get it back until the end, what the fund closes out. So, the money's going to purchase, to renovate, and it's illiquid until the end. Changes in market conditions such that homes do not appreciate as anticipated. That's always possible. We don't expect it, but you never know. And reliance on key personnel. This is something to always ask whenever you do a fund or any kind of syndication, is what happens if something happens to the managers, God forbid. So Leah, tell us what we would do if we lost you.
Well, first and foremost, my husband and I own the company together. So if something were to happen to one of us, the other one would step in and take over. We both have owned our company the entire time. So 50-50 owners. In addition to that, I have 2 full-time attorneys who work for me who have a succession plan that can step in, and my lead general counsel, which is a 3rd attorney. So there's plenty of people who can pick right up where I leave off. But I don't really worry about that too much. I'm in my 30s. I hope I have a long life left to live with many more funds.
Yes. And you have been so healthy.
So business activities such as purchases, sales, and refinancing. So we'll be providing information on what the situation is in that moment, what we've done. I'll be providing before and after photos and information on what type of leases we got and all of that. And probably what I think I'm going to do is set up a place where you can go and view all of that. And Kathy, you and I'll figure that out. But I love to show before and afters. And so I might even make like a little Facebook page or something for that people can go follow. Of course, key information about the assets under management, locations, the status of deployment or development, and quarterly unaudited financial statements, information reasonably necessary for the preparation of income, tax returns annually, including Schedule K-1s, and then other such periodic reporting is provided for in the operating agreement.
And our new software, InvestNext, that you all are in this portal, it has a wonderful way of showing these reports. So you'll just be able to log in and see how the investment is doing. And a lot of those updates and photos we can upload there as well. So it's a much better system than we've been using. I'm very excited about it. It's an upgrade. Okay. Anne Triplett, many of you probably already know her. She's been working in the Real Wealth Syndications department for years. And Kathy McBride has helped many real wealth investors with investor communications. So they'll be helping if you have any questions about the subscription agreement, because this is only open to accredited investors and it's a 506C. The SEC requires that you have proof of your accredited investor status, and that could come from a CPA or an attorney or from a verifyinvestor.com. So you would return those documents with your signed PPM, which you can sign it through the portal and then upload your documents there. Kathy and Ann will be reviewing them and making sure everything was done correctly. So they are there for you. And actually, the new email is going to be questions@growdevelopments.com. That's how you'll reach them, questions@growdevelopments.com. Okay, so I expect we'll get lots of questions, and I much prefer that all those questions come in at once and that we set up a Q&A webinar, because sometimes we get the most brilliant investors that ask really good questions, and I don't want that to be a one-on-one conversation. I want everybody to be able to hear the answer, because it may be something you didn't think about. Or it may be, the same question. Let's just answer it together. So be sure to submit your questions to questions@growdevelopments.com, and we'll set up a Q&A probably every week, because we know there'll be lots of questions coming in. So with that, we are very, very excited to be partnering with Leah and her husband and their great company, and being able to get in such a hot market that is pretty tough for an outsider. So Leah, we're just really, really honored you chose us, and we're excited to launch our first fund. Can't wait for any more.
Can't wait.
All right. Thank you all.